Hello, good morning to all. Welcome to today's daily dose of market insights by OANDA. Hi, good morning to all. Welcome to today's daily dose of market insights by OANDA, presented by myself, Kelvin Wong, the senior market analyst of OANDA Asia Pacific. So very good morning to all. Today is Thursday, 21st of September. So before we start our usual daily dose of market insights, let's take a look at the disclaimer slides first. All right, so leverage trading carries a high degree of risk and may not be suitable for everyone. And this presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, so as usual, before we start our daily dose of market insights, these are the three key takeaways that I like to share with you all for every day, which is a recap of highlights and data that was actually released yesterday, and what's next to watch out for in terms of events and data releases for the upcoming session for today, and as well as early Singapore time for tomorrow, and as well as to wrap it up will be the short-term technical analysis outlook on the respective asset classes that I'll share with you all that has an interesting configuration. So now, without further ado, let's take a look at what happened overnight. Okay, so as you all know that the most important thing that took shape overnight was the US Federal Reserve FOMC meeting, and as well as the more important is the release of the dot plot. Okay, what is dot plot? Those who joined me yesterday, dot plot is actually the Federal Reserve officials' expectation of interest rate, expectation on future US economic growth, and expectation on future US inflationary growth that actually they project. And this dot plot, they don't release it in every meeting. They only release it in every 3 meeting. That means the last release was in June, and this time around 3 months later was in September. And most importantly, the Federal Reserve Fed Powell press conference. So later I'll share with you what actually the key highlights of the dot plot, but most importantly, yesterday was actually a hawkish pause in terms of the Fed funds rate. So as you all know that Fed fund rate market has already stating that high chance the Fed will not actually hike yesterday, or we talk about early Singapore time, which is 2 a.m. So they maintain the Fed fund rate at 5.25% and 5.5%. But what during Fed Powell press conference, and also the highlight of the latest data from the dot plot projection actually indicate that the thinking of the Federal Reserve is they do expect inflation to stay sticky for a longer period. That means, i.e., they are actually in favor of having the Fed fund rate to maintain at a higher level for a longer period of time. So that actually drive up the US Treasury yield. So think of US Treasury yield as a benchmark for borrowing costs globally. The 2-year and the 10-year both push up much higher. And most importantly, the 2-year actually rose much higher than the 10-year that caused the US yield curve inversion to actually take shape again. So later I'll share you the chart what is this 210 inversion. But most importantly, like we did mention a couple of sessions ago, that this is within our expectation, where there's a high chance, high probability that the US Federal Reserve will want a weaker demand to actually offset inflationary pressure that is driven by oil prices. I shared with you yesterday the relationship between higher oil prices and higher inflation expectation. And what does that have, we call it entail to the markets? For sure, the US stock market sold off yesterday. So especially, I did mention to take a look at of long duration risk asset or risk equity, primarily the growth stocks that has very high weightage in the Nasdaq 100, which is the mega cap stocks. Why growth stocks? Because these mega cap stocks or tech stocks are actually dependent on much more on future, that means not near term, that means longer term cash inflow or revenue And this cash inflow or revenue in the longer term, that is pretty much dependent on them because those are growth stocks. Their future revenue or cash inflow will get lesser if we discount back with a higher interest rate factor. So their we call it current valuation will definitely get impacted given the fact that these stocks valuation are relatively higher compared to the benchmark, we call it S&P 500. So for sure, the Nasdaq 100 was actually the worst performer yesterday, down negative 1.46%. The S&P down negative 0.94%. The Dow Jones actually also closed negative, but slightly better at negative 0.22%. And the second other worst hit was the Russell 2000, which is the small cap stocks, which is all pretty much growth stocks as well, down negative 0.9%. So right now, right, if I were to share with you my screen on the heat map of the S&P 500 over here. Okay, so now let me focus more on the screen instead rather than my camera. Okay, so so you could see over here is that a sea of red in the mega cap stocks over here. So going forward, it will be pretty much challenging to actually for the growth stocks to actually maintain their upside momentum that was seen at the start of this year. So the next big event to watch out for will be US earnings session, will be Q3 earnings. So that will be up around in 2.5 weeks time. All right. So for sure now, pardon me, for now the momentum is rather weak on the US stocks. All right, for the US mega cap stocks. So now let's take a look at the dot plot. So basically this is what the latest dot plot that we see so far. So I want to highlight for you, all right, is the Fed fund rate. Okay, so Fed fund rate right over here, Fed fund rate. So this is the projection. So for 2023, 5.6%, no change in the June projection, 5.6%. So what it means that based on the current Fed fund rate right now, which is 5.25% and 5.5%, yesterday no hike, no. So there will be another minimum one more hike to come in before 2023 end, either in November or December. But what's interesting over here is that in the June projection, they forecast 4.6%. And right now, yesterday, they up it to 5.1%. So there's a pretty much big jump of 50 basis point. All right. And also similarly in 2025, previously they push it down to 3.4%, but right now they up it to 3.9%. So what it actually implies in the Federal Reserve officials thinking that very high chance we will start to actually see a period of longer interest rate at a higher level. Okay, but what's interesting over here is they are pretty much rosy in terms of GDP projection, real GDP, not nominal, real GDP. So for June projection, by the end of 2023, annualized, previously they are looking at 1%, now they up it to 2.1%. And similar for 2024, previously 1.1, they up it to 1.5%. All right. And also, what's interesting over here is the core PCE inflation. That means excluding energy and food. For the June one, previously 3.9%, they expect to inch down slightly at 3.7% end of the year, but maintain unchanged for 2024 at 2.6. Previously, June projection was 2.6. For yesterday projection, 2.6 as well. So what they are expecting over here is that they do not believe that the US economy may go into a recession even in next year. That's their thinking. But do not forget, markets are always moving ahead before real economic activities take shape. So with a higher interest rate being priced into, with a higher interest rate being projected, there's a higher chance that this liquidity will get tighter next year. Definitely, cost of funding will start to push up. So unless earnings growth starts to surpass cost of funding, then economic activity will start to be much rosy within the Fed expectation. So if earnings growth do not pick up as what intended by the Fed, there's still a high chance that the US may start to slip into a recession next year, given the fact that stock prices tends to be a leading indicator of economic growth. So if stock prices in the US stock market, the benchmark stock market, especially the one that is leading, which is the Nasdaq 100, continue to tumble and break below the October low of last year, potentially there could be a higher chance of a recession in US for next year. So we should actually continue to monitor the movement of the leading index, which is the Nasdaq 100. Okay, so that's for the dot plot projection. So how market pricing right now in terms of the interest rate futures. So now let's take a look at the CME Fed Watch tool, which is data derived from the Fed Funds interest rate futures market. So for the November meeting, right now we have a 28.4% odds of a hike coming in at 5.5 to bring it to 5.5 to 5.75%. So that's another 25 basis point hike. So almost unchanged from yesterday price, almost unchanged. All right, about a month ago it's at 33%. Then if you will look at the December meeting, okay, slightly higher at 39.4%. So right now what we could see over here is that the market is now pricing in at least one more hike to come in November or December. So now the most interesting is what will happen next after this so-called potential final hike of 25 basis point to bring the terminal rate to 5.5% to 5.75% on the Fed fund rate. So let's go to the probability right now. The we call it the aggregate probability and expand it. Okay. So previously, what I shared with you all in my previous daily dose of market insight is that in June, previously there was a high chance of at least 50% chance of the first rate cut to come in June. But you look at the probability now has been reduced after yesterday's dot plot projection, all right, to keep Fed fund rate at a higher level for a longer period of time. So now it has dropped down to 35% only. So June, July, and September. So now market now has starts to price for backward. That means they actually put away that instead of bringing forward the first rate cut, now they bring backward the first rate cut. Okay, so the first rate cut instead of previously was expecting to come in May and June. So now even May now has dropped down to 19%. June 1, 35%. So now the higher odds will come in much later in July and September, 52 and 70%, which is to me is still pretty much rosy. Given the fact that the Fed may start to adjust the expectation again going forward into the early part of next year. So, but for sure, we know now that the first rate cut to come in going to be pushed forward rather than push backward rather than pushing forward. So it may start now to June and July instead. All right, to July instead rather than May and June that was earlier priced much earlier at the start of this month. All right, so all in all, a hawkish pause, short term, not rosy for risk asset on equity as per se. All right, so now let's now go on to the economic calendar. What are the things to watch out for today? Okay, so for today, BOE interest rate decision, Bank of England, that could impact the sterling side of the story. 7 p.m. Singapore time. Market is expecting one more rate hike. Okay, 5.5%. So will this be a dovish hike? High chance. Why? That means dovish hike as in this will be the last hike. Then after that, BOE will be like ECB, be more data dependent and sound that pretty much concerned about their current higher interest rate towards their economy. Why? Because if you look at the previous GDP data on the monthly one for July, it actually dropped down to negative. And most importantly, if you look at yesterday, there's a release of the inflation data as well. So if you look at the inflation data, the core inflation year on year actually fall below expectation. The expectation was 6.8% year on year. Previously was 6.9%, and it actually fall below expectation and the previous month of June. So if you look at the trend on the core inflation data, all right, it starts to dip down towards hitting previously almost the same level at the start of the year. All right. So all in all, right, it seems that inflationary pressures in UK has more or less tempered off. So what it means that the previous hawkish vibe of BOE or hawkish stance of BOE has starts to be working to actually drive down core inflation pressure to a much lower speed of increase. So, i.e., what do I mean by that? So that could actually be implying that this could be the last hike of BOE. Where is it? Okay, give me a minute. Yeah, the last hike of BOE to take it to 5.5%. Okay, so now going forward, what will take shape later? US session, nothing much. Okay, then you have ECB at 10 p.m. Governor President Lagarde, she will be speaking. Then US, you have assisting home sales at 10 p.m. And going forward, early morning Asia session will be the key one will be Japan inflation data, then followed by flash manufacturing data as well for Japan for the month of September and services for September, and most importantly BOJ interest rate decision. So this time around BOJ, there will be no accompanying latest economic data released in Japan, so very unlikely they will do anything. But do watch out for the BOJ governor press conference that's out later at Singapore time 2:30 p.m., which is the close of the Japan stock market. So market will be listening to him, his guidance on the negative interest rate, because previously in one of the public press, we call it a statement, he did mention about that quietly exiting from negative interest rate, and market now has an expectation of an early indication that this negative interest rate might start to change at the start of next year. That means, i.e., there could be a first interest rate hike by BOJ early next year. So all that will be listening to BOJ Governor Yuda's speech, press conference at 2:30 p.m. Singapore time on Friday. All right. So now let's take a look at the markets, the short-term technical outlook. So very quickly, let's start with the indices first. All right. Okay, index. Okay, so let's start with the Hong Kong 33. So Hong Kong 33 yesterday, we do have a bullish bias holding this support at 17,770, looking for a bounce up towards this area here at 18,820. So the bounce actually fall short and price actually tumbled in line with the negative feedback loop that we see in the US benchmark stock indices. So right now it's actually touching, coming very close to the 21st of August low, which is at 17,570. Hourly RSI, there's no bullish divergence. Yes, even though it's oversold, but no bullish divergence. So indicating to us that yes, there could be a bit of bounce coming at 17,570, but with the lack of bullish divergence, this downside momentum still remains potentially intact on the shorter term. So I'll be using yesterday's high, US session high, which is 18,060 as my key short-term pivotal resistance, to have a short-term bearish bias heading towards 17,570. A break below potentially could take us down towards the next support level at 17,370. So what 17,370 is in fact the previous, if you go to the daily chart over here, okay, is this previous swing low of 22nd of November and 28th of November last year. So that's 17,360 for you. Okay, so now let's go to the hourly chart again. Okay, so that's how I define the next support at 17,370. However, if we start to see a clearance and hourly close above 18,060 level, then this short-term bearish bias will be invalidated to see a squeeze up to retest 15th of September's minor swing high at 18,370 level. All right, so that's for the Hong Kong 33 or the Hang Seng Index. So now moving to the German 30 index. So the German 30 index over here is that yesterday price action actually reacted a bit of whipsaw at the 15,780 key short-term pivotal resistance that we highlight before plunging downwards. So a bit of whipsaw here. So I will still maintain that short-term bearish bias 15,780 slash 15,810. Given that whipsaw yesterday. So looking for the next support level to come in at 15,570, which is the swing low area of 30th of September, 8th of September and 25th of August, and as well as close to the 200-day moving average. A break below potentially sees the next support level at 15,470, which is the swing low of 19th of August. But however, we start to see a breakup above 15,810 level, then we could see another potential choppy up move to test the 50-day moving average, which is acting as resistance at close to the 15,870 level as well for the German 30 index. So still maintaining that short-term bearish bias on the German 30 index. All right. So now the Dow Jones Industrial Average price action reacted off nicely right at the key short-term pivotal resistance that we have yesterday at 34,780. Now coming close to our short-term support level that we highlighted earlier, 34,335. There is no clear bullish divergence on the RSI oscillator, so still maintaining that short-term bearish bias on the US Wall Street 30 index, now with a tightened key short-term pivotal resistance at 34,625, which is also the 20-day moving average, and as well as the 61.8% FIBO retracement of yesterday's plunge. All right, over here, at also confluencing at 34,625 key tightened key short-term pivotal resistance. So still maintaining that short-term bearish bias. A break below 34,335 exposes the next short-term support level at 34,100, which is the swing low area of 25th of August and 24th of August swing low area. All right. However, if you start to see a clearance and hourly close above 34,625, then potentially we could see a kind of a choppy corrective rebound to retest yesterday's swing high area at 34,780. All right. Now moving on will be the Nasdaq 100. So if you look at the Nasdaq 100 over here, yesterday price action actually reacted off the short-term pivotal resistance and hit that short-term support level that we mentioned, 14,915 level. RSI now at oversold level, but no bullish divergence. So perhaps we may see a bit of bounce back up towards 15,037. But however, without any clear signs of a bullish divergence in the short term, bearish momentum still remains intact. So we'll be having a tightened key short-term pivotal support level for today at 15,170. So what's 15,170? If you are to do the thing over here, so it's close to the 61.8 FIBO retracement as well, slightly higher. So at 15,170. So as long as this 15,170 hold resistance is not surpassed, potentially we could see another push down to test the next short-term support level at 14,750. So overall, the technical picture still remains bearish on the Nasdaq 100 in the short term. But however, if we start to see a clearance above 15,170, then potentially we'll see a squeeze up to test this 20-day moving average, acting as resistance at 15,290. Also confluencing the swing high of 19th of September, as well as the former minor ascending channel support now turns into a pullback resistance, also confluencing at 15,290. All right, so still maintaining that short-term bearish bias on the Nasdaq 100. Right, so now flipping to the FX market. So over the FX market over here, let us start with the dollar yen first. So very interesting for the dollar yen. Dollar yen actually squeezed up for the 47.90 resistance that we highlighted. But what it's doing over here right now, right, in terms of the price action, yes, it's still holding above the 20-day MA ahead of yet tomorrow key event, which is the BOJ meeting, and as well as the release of Japan inflation data and the preliminary manufacturing and services PMI for September. So there'll be going to be a bit of volatile movement on the dollar yen. But what's interesting over here is that it's now fast approaching a key medium-term resistance at 4840/4885. And the way the price action configured over here, since the low of 24th of August, this is what I call in technical analysis, what I call a bearish ascending wedge that means it's a sign of bullish exhaustion. And most importantly, when the price converts in this bearish ascending wedge configuration, higher high, higher low, but however, the corresponding RSI is shaping downwards, lower high instead. Can you see over here, lower higher, but price action going to push higher and form this bearish ascending wedge, approaching a key medium-term resistance. All right, at 148.40/85. So what it means that over here is that momentum is not great on the medium term, even though price action continue to push higher. So I'll be a bit cautious on the bullish side right now, given the fact that of this potential bullish exhaustion element that's been depicted on a higher time frame chart, which is the daily chart. So on the shorter term time frame, that means on the hourly chart, I will have a neutral stance instead at 148.85 and 147.55. So that is yesterday's US session lower, 14755. So neutral between these two levels for now. Unless we see a breakdown at 14755, then we will reinstate our bearish bias to test that 14630 level. Okay, so having a neutrality stance for now between 148.85 and 147.55. Okay, but however, if we start to see early a breakup or hourly close above 148.85, then potentially we could see a squeeze up towards the major resistance level at 149.80/150, the psychological level. Okay, so what's 150? 150, if you look at the daily chart, is the major swing high area of October last year, where actually BOJ actually intervened to actually sell dollar yen to push it down. So also do keep a close watch because it's coming very close to this potential level, where potential zone where MOF the Ministry of Finance will start to make a bit of noise regarding about this strong dollar strength against the yen. Okay, now what's up next for the other currency? So let's take a look at over here will be the euro dollar. So you could look at the euro dollar. Okay, what you see over here is that yesterday it actually did a bit of it plunged down, hit the support level that we mentioned. So a bit of whipsaw at the 107.07 key short-term pivotal resistance. So I will give a bit of a whipsaw over here slash 107.40 as my key short-term pivotal resistance for. I hasn't hit the oversold region yet, no clear bullish divergence as well. So still maintaining that short-term bearish bias. So I don't want to target too. So using this swing high area, 107.40. Maintain that short-term bearish bias to hit the next support level at 105.85. All right, but however, you start to see a squeeze up above 107.40, then potentially we could start to see a push up to test the next resistance level at 107.70 on the euro dollar. So now going forward will be the sterling dollar. So if you look at the sterling dollar over here, it seems to me that it's now coming very close. It really hit the support level that we mentioned yesterday at 23.40 level. So what we could see over here is we will actually have a tightened key short-term pivotal resistance for today at 23.80 level to maintain that short-term bearish bias. Break below 123.40 potentially sees the next support coming in at 122.45. However, if we start to see a break up above 123.80 and hourly close above it, could potentially take us up towards the next resistance level at 124.45, which is also the 200-day moving average. Okay, so now that's for the FX market. So very quickly, we're coming to the 30-minute mark already. So let us touch on the commodity. So commodity, right, let's start with the WTI crude oil price first. So for WTI crude, yesterday we have this bearish bias. So still no change, still using 93.80 as my key short-term pivotal resistance. Price actually is going to slide downwards. But still holding at that 89.50 minor support level. So a break below this minor support level potentially could see the next support coming in at 86.30, which is the 20-day moving average as well, acting as a support, and also this minor ascending trendline support linking the lows of 23rd of August. So all in all, right, what I could see is a potential corrective pullback holding below 93.80 within a longer term major bullish trend for the WTI crude oil price. Okay, now what's next for gold? So if you look at for gold over here is that if you recall for gold, we do have previously yesterday we do have a bullish bias at 1948. So price action yesterday hit almost 1948, 947.46 give or take is almost there. So yeah, gold prices start to plunge in line with the strength of dollar strength coming back into picture, but managed to help at the 200-day moving average, which was yesterday key short-term pivotal support as well at 1922. So we will have more of a neutral stance right now given mixed elements. So neutral in short term between 1937 and 1922. Unless we have a clear break up above 1937, then we will actually kind of have a resurgence of this short-term bullish bias back into gold. So neutral between 1937 and 1922. However, we start to see an hourly breakdown below 1922, then we will see a further push down to test the next support at 1913, which is the major ascending channel support from the low of 3rd of November last year. So flipping to a neutrality stance for gold for today, given the dollar strength has starts to come back into the picture, at least for the short term. So neutral between 1937 and 1922 for gold. Spot gold, I mean. So with that, yep, we will come, yeah, we have already come to the 32-minute mark for today's daily market dose. So with that, I'll end today's session. So do have a great day ahead, and we shall speak again tomorrow. Thank you.